Hello, everyone. Welcome back to Financial Path.
In life, we all face moments when we must make significant choices. Renting versus buying a home is one of those decisions almost everyone must consider sooner or later. We're often taught that renting is a waste of money and buying is always a smarter move. At the same time, owning a dream home is an aspiration for many. Yet for most people relying on their salaries, buying a home represents a significant financial commitment. The fluctuating economy and today's high housing prices make it natural to worry, is this truly the right investment? In today's video, I'll walk you through a real-world case using actual historical data in two different ways to explore whether renting or buying makes more financial sense under specific economic conditions. My aim is that, through the explanation, you can also use it when facing a similar choice. First, I will apply the net present value method, just like investment professionals do. Then I will use a more straightforward, intuitive approach to calculate how much money you'd end up with. By the end of this video, I believe you can use the same methods to deal with similar real-life issues and have a clearer view of how to make a smarter choice. Let's get started. I don't live in the United States, so to stay objective, I didn't select today's case study location by myself. Instead, I followed ChatGPT's suggestion based on real-world market trends. Let's consider a real house recently listed for sale in Phoenix, Arizona, one of the fastest-growing cities in the U.S. This property is a 3-bedroom, 2-bathroom single-family home, offering about 1,630 square feet of living space. It's located in a typical suburban neighborhood and is currently listed for $419,000 on Zillow. According to Zillow's latest rental market trends report, the average rent for a 3-bedroom house in Phoenix is about $2,870 per month, and the average size is 1,647 square feet. This makes it a realistic comparison for our case study. Over the past decade, home prices in Phoenix have more than doubled. However, in the past year, average home values have slightly declined by about 1.7%, reflecting broader economic uncertainties. Interestingly, the specific house we're analyzing was previously sold for $183,000 in 2014, slightly below its listed price of $189,900 at the time, about a 3.6% decrease. Now it's listed at $419,000. Assuming a similar 3.6% negotiation discount today, the final sold price would be around $403,916. Based on these figures, the home's value has increased by approximately 120% over the past 11 years, translating into an average annual growth rate of about 10.9%. According to Investopedia, the typical U.S. homeowner stayed in their property for an average of 13.4 years in 2020, but by 2024, this figure had dropped to around 11.8 years. So, for simplicity, I will assume the buyer plans to stay in the home for about 10 years. With these real-world facts, we can now dive deeper to answer a big question. Is buying or renting this home smarter? Now that we understand the case details, let's discuss how I will compare renting to buying this home. I will analyze the choice in this video using two different financial methods. First, we'll use the net present value method, or NPV for short. Professional investors often use this method. It examines all the cash flows involved, including costs and benefits, and discounts them back to today's value using a reasonable discount rate. I've already explained the NPV method in another video, renting versus buying a home, a gold standard revealed in 15 minutes. You can watch it if you want to explore further. Second, I will use the future wealth method. This approach is a little more intuitive. I will calculate how much wealth the house can bring to a family at the end of the evaluation period in each option and compare them. Both methods are powerful, but they focus on different perspectives. I personally like the NPV method because it is more accurate. The NPV method sees how much wealth the investment can bring us or how much money we will spend in total today. The future wealth method focuses on the total wealth accumulated over time. Ideally, both methods should point toward the same smarter choice. Before I proceed with the calculations, let's review the key assumptions and data we'll use to compare buying and renting this home. Starting with the buying scenario. The home is listed at $419,000. Based on the house's past selling pattern, where it previously sold at around 3.6% below the list price, we'll assume a final purchase price of approximately $403,916. We assume a 20% down payment for financing, a standard requirement to avoid private mortgage insurance, and a 30-year fixed mortgage at an interest rate of 6.5%, reflecting current market conditions in 2025. In addition to the mortgage, homeowners face other ongoing costs. Based on Zillow's tax history for this specific home, we'll initially assume property taxes of $1,392 and estimate a modest 2% annual increase moving forward. Homeowners insurance is assumed at $1,200 per year, based on Arizona averages, and maintenance costs are estimated at 1% of the home's value each year, a common rule of thumb used in real estate planning. To account for the selling process at the end of the ownership period, we'll also include 6% of the future home value as selling costs, covering agent commissions and closing expenses. Even though our case house in Phoenix has increased in home value by 10.9% annually over the last decade, the average house value in Phoenix declined by 1.7% in 2024 compared to 2023. This makes us conservative about the home value appreciation rate, with 3% annually moving forward. Now turning to the renting scenario. According to Zillow's latest rental market trends report, the average rent for a 3-bedroom house in Phoenix is about $2,870 per month. We'll assume rent will increase by 3% per year, reflecting historical average rent growth. In terms of upfront costs, renters typically pay a security deposit equal to 1 month's rent, which is refundable at the end of the lease, provided no major damages. Renters also need to carry renter's insurance, which is quite affordable, around $200 per year based on Arizona averages. Unlike homeowners, renters don't pay for property taxes, major maintenance, or homeowner's insurance. Most importantly, instead of putting down a large down payment and other upfront costs on a house, renters have the opportunity to invest their savings. In addition, the rent is higher than a mortgage, resulting in the excess being unable to invest in the stock market to produce a gain. The opportunity loss has to be considered. We'll assume those investments earn a 6% annual return, which is consistent with long-term historical returns of the U.S. stock market, adjusted for inflation. We can proceed to the detailed financial calculation with these clearly defined assumptions. The necessary data, let's look at the net present value results for buying versus renting this home over the next 10 years. Based on my detailed cash flow calculation, the NPV of buying the house is approximately negative $187,390. Meanwhile, the NPV for renting the house is approximately negative at $289,239. Both options show negative NPVs. This means that if the future data goes as expected, the house will cause loss to the family, whether renting or buying. So, from the investment perspective, the house shouldn't be touched. However, in this case, the negative NPV for renting is significantly larger than that for buying. So, buying the house is a relatively smart choice from a purely consumptive aspect. It's important to remember that NPV focuses on today's dollar value of all future cash flows, helping us understand the financial impact in a very rational, investment-style way. But sometimes people find NPV calculations less intuitive. Next, we'll use a second method, comparing the final wealth position under both buying and renting to double-check and confirm which path leads to better financial outcomes. Let's review the results based on the second method. After calculating all the cash flows and investment returns over the 10-year period, here's what I find. Buying the house would lead to a final loss of approximately $163,259 to the family's overall wealth. Renting the house would cause an even larger final loss, about $331,761. Like the NPV method, this future wealth comparison also tells the same story. So we can see that both renting and buying the house result in a financial loss over the 10 years. This method again tells us that buying the house should not be a good investment opportunity. The reason for buying the house also causes a final financial loss, mainly due to the loan interest, which is 6.5%, higher than our assumed house value increase of 3%. So you pay more than you get from home value appreciation. However, when we view buying and renting as forms of necessary consumption, as places to live and build a life, the analysis shows that buying is a smarter choice. It leads to a smaller loss in wealth compared to renting over the same period. So not every decision in the real world is about investment returns. Your choice may be to find a way to reduce financial loss. Now let's move on to summarize everything we've learned today. We carefully analyzed renting versus buying a home using a real-world case, backed by historical data, realistic assumptions, and 2 professional financial methods. Both methods led us to the same conclusion. Buying the home is a relatively smarter choice than renting, even though both involve significant financial costs over time. Based on the numbers, buying this home would not be a good investment. But real life is not only about investment returns. Buying a home is both a consumption and emotional decision. It provides shelter, stability, and often emotional value that cannot be captured in financial models. Therefore, even though the house in the case may not be an ideal investment, buying is still a smarter choice than renting for someone who needs a stable place to live and wants to minimize long-term financial loss. In this case, buying is a relatively smarter choice than renting. However, renting might be better financially in other situations. So, the saying that renting is throwing money and buying a home is always winning is incorrect. Each big decision needs to be evaluated individually. In addition, your decision should always consider the combination of your personal needs, lifestyle goals, future plans, and financial numbers instead of only the monetary amount. I hope today's detailed walkthrough can give you a complete picture to help you consider renting versus buying a home more clearly and realistically. Thank you for watching. If you found this analysis valuable, don't forget to like, subscribe, and join me next time for more real-world financial insights.